I'm going to be quick on this stuff. There's a lot here. We're not going to go deep on especially real estate and solar. We're going to focus maybe a little bit on oil and gas because it's available and high value and doable this year. I'll get asked a question about CRUTs. I want to answer it. Yes, a CRUT can work for an IPO for sure. If you have options that have not yet been exercised, it gets a little bit complicated. This is a great case for scheduling a call with us. We can walk through your precise case, run the numbers, and answer all of those questions for sure. Real estate, the idea here is that you're buying an asset that entitles you to significant income, yes, but also depreciation. Depreciation is almost the entire tax value of real estate and STR, short-term rentals. The idea is that you can deduct much of the value of the property over the next few years and use it to write off not only the income from the real estate, but potentially your earned income, your W-2 as well. The way to do that at a very high level is twofold. When it comes to figuring out what income you can write off, you can always write off passive income. You can also write off active income if you become a real estate professional. I'm sure many of you have come across the requirements that you spend $750. Very often there'll be a working spouse and a real estate spouse. If you want to do that, you need to look into the details. It's definitely not something that you're going to do this year, but you can pursue for next year, and it can be powerful to write off ordinary income. Specifically, how to get the maximum depreciation, that's where cost segregation comes in. The idea here being that if you engage a cost segregation appraisal specialist to run a study, you can get the precise value of all of the different components of the property, the land, the personal property, the real property, the building. And each of those pieces is on a different depreciation schedule. And some of them are on accelerated schedules. And so you can write off the depreciation even quicker if you do that. Sandeep, going back, asks, can we fund a CLAT with stocks, RSUs? Absolutely, 100%. You can fund a CLAT with almost anything, including cash and stock. Solar, also going to speed through here because to answer a question that was asked, unfortunately, solar is at least going through Valor, and I think anyone else will tell you the same. It's too late to do solar this year, just because the requirement is that you invest in solar and that the project be completed by the end of the year. Now, there is a 90-day grace period in some narrow cases, but those are on lower value projects that Valor doesn't do. And as a result, solar is done for the year. That being said, it is a very powerful strategy for ordinary income, and it's probably the thing that most of our clients pursue over the course of the year. So it's worth double clicking for 2 minutes on it. The idea with solar is that you are purchasing physical infrastructure. You're buying solar panels that are sitting on the roof of a commercial building or a community center. And yes, to answer the question, you can do this with Valor, or sitting on a residential development out in California. You become the owner of that project, and in return, you get 3 financial benefits. The first, and this is where the credit and deduction distinction comes in. The first is a tax credit. If you put $100,000 into solar, there's a lot of math behind the scenes here that we can talk about maybe another time, or you can check out our calculators. But if you put $100,000 into solar, you're probably going to yield something like an $80,000 federal tax credit. The math, again, is complicated. I'm not going to spend the time here. We've done a solar webinar, which you can find on YouTube if you want to check it out early in January to talk in more depth. But you get a tax credit. You get a depreciation deduction, which is, again, just like with real estate, you get to deduct the value of the solar panels that the IRS assumes to be lost over time as these things lose value just because they're physical infrastructure. You get to deduct that value over 5 or 6 years. It's also front loaded. It's on what's called the bonus depreciation schedule. And you're able to take much of that depreciation in year 1. And then the third benefit is income. This is, you own a business, a project that produces electricity that is then sold, and you get income from that. This is all run by someone else. You don't need to go out and find a buyer for the electricity. It's actually very simple, and Valor helps you with it. But all in all, we're talking about, in the first year, potentially as much as $1.30 in tax savings for every dollar that you purchase of solar panels. If you put $100,000 in and you live in California, you're going to be able to reduce your taxes by as much as $130,000. And that's not a typo. I'm not misspeaking. You're getting back more and potentially much more than you're putting in. And as a result, as I said, solar is very, very popular. And if you're interested, strongly suggest that you get in touch with us early in the new year, really in the first quarter, to get moving on that, at least to start exploring and kicking the tires. There are some requirements there. Material participation, you have to spend 100 hours in the solar business. You also have to do your diligence on the particular developer you're working with. Again, we've got 4 minutes left. I'm not going to belabor those points since this is out of the picture for this year. I want to leave those 4 minutes and maybe a little bit longer. Solar will survive under Trump, in our view, for a lot of reasons. It was passed in a bipartisan fashion, 50-something votes. Seems very unlikely that this particular very popular program is going anywhere, but we'll keep an eye on it. It also won't be removed retroactively. If you invest in January, there's rules that prevent the government from taking away those benefits once you've invested. And then the last topic here, which Farhan's going to talk about, is oil and gas, which is the last one of these and the most valuable one that is still available this year.
Thank you, Jeff. Real estate requires you to put in certain amount of hours, is 750, and solar requires you to put minimum 100 hours within a calendar year, and that's why it's just not executable within the. With oil and gas, the way this works is you put money in a fund and fund invest that money into, well, say, drill oil and gas. The distinction here is that oil and gas doesn't require you to put any hours into it. It doesn't require you to set up any entity, and that's why it's a very simple structure. And we're talking on 18th of December, and we can say with very much confidence that we still have time to do it, at least till December 27th. The good part is with oil and gas, if you put $1 in, you are able to close above 90, 92, 93 cents, but just for the sake of selling it slightly conservative approach. If you put $1 in, you can get 90 cents worth of a reduction against your federal AGI. A lot of states accept you'd have to check. California doesn't. We know we have a lot of client base in California. California doesn't. But if you put $1 in, you are able to get 90 cents worth of a reduction against your AGI. You are able to get it 17 cents from year 2 through 7 with the depreciation schedules. If you combine them, you get to 107. But that's a depreciation. That's aside. You are also entitled to cash flow. As the fund is going to drill oil and gas, there's going to be cash flow that's going to get generated. And you would be able to take that cash flow. However, no one is going to commit to you a definitive percentage because, as everyone knows, oil and gas prices are highly volatile based on oil and gas prices, what's going on into international politics and everything. But what we have seen historically, that people have been able to get their money out and more over the course of 4 to 5 years. First couple of years are very aggressive because they extract majority amount of oil and gas. It's a very simple, plain vanilla structure. So Iris is not going to come back and ask you why you weren't active, why didn't you spend any hours? It's just safest thing you can do out of all three. In terms of if you connected with DAFs, it's the same profile. In DAFs, you're going to lose the dollar. Here you get more than $1 worth of deduction. 90 cents in year one, not bad. But you have an upside of making your money, more on top of it. 15% of the income is tax deductible. We've seen people making 150, 200% cash on cash return. We're happy to dive into it and can explain in more details that, how that works and everything, the nuances with it. But just to, lay it out, this is available. You can execute it with the time that you have left, and we're happy to chat about it.
Someone asked about minimum investment is $100,000 minimum on oil and gas. You can absolutely do it this year. The oil and gas is maybe the closest thing that we do to an investment strategy. It's really a hybrid, right? Solar is mostly a tax play, and then there's some revenue that comes along with it. Donor advised funds, CLATs, CRUTs, these are tax strategies, and you invest within them. Oil and gas is really hybrid. It's 50-50. You're getting a very large tax deduction in the first year and a little bit in future years. And as a result, you're basically getting something like a third to half of your invested capital back in tax savings. But this isn't going to be valuable unless the fund returns cash flow. And so as you're evaluating this for yourself, what you need to look at is the historical returns, which we have on our site. You can, again, check out learn.valor.com. Look at the oil and gas materials, and you need to decide if you believe that those are likely to continue or potentially improve. And I think there are reasons, technological and policy, to expect that these funds are going to return more than they have historically. But it's still something you have to underwrite, something that you have to decide on for yourself and decide whether you believe that this is going to return money the way that it has historically. And if it does, then it's very, very strong and positive. And like Farhan said, we've got dozens of clients pursuing this, but it does require a little bit more belief in the underlying investment.
That's right. And one thing to call out here, I mean, even if you're looking at, real estate and solar, there is, clearly a 750 hours requirement with real estate. That means that's a lot of time that you would have to put in. I mean, it's like, there's an underlying requirement of it has to be, 50% of your working hours. And with solar, the requirement is slightly lower, but it's 100 hours. So there's work that needed to be done in order to achieve solar. The beauty of oil and gas is, one is the material participation, which means you're not doing anything. You're not running fund, and you're not going down and feeding about oil and gas and how's it doing and what are the drilling pits and where the wells are located, and time is money, in a sense.
Oil and gas is the lowest overhead thing that Valor does. And answering the question again, minimum investment for oil and gas is $100,000. And answering one more, California, you can invest in oil and gas. California does not recognize the deduction, so you won't get a state deduction, but you still get the max federal. Valor helps with many of the things we've talked about today. Essentially everything except tax deferred plans like IRAs and 401ks and donor advised funds. If you want to do a foundation, if you want to do a CRUT, a CLAT, solar, oil and gas, Valor can help. And oil and gas is the thing that requires the least setup, the least overhead, the least involvement from you. And that's fortunate because we've only got a couple of days left in the year to get it done. But if you're interested, it is absolutely still viable. But I'd strongly suggest that you get in touch within the next 2 or 3 days, at least to kick the tires and get the process started.
Mm-hmm.